Okay, today we're going to talk about something very near and dear to all of our hearts, taxes. And that really hits home about now because it's tax season. Who pays taxes? Anybody that works and makes an income has to pay, is responsible for paying taxes. Imagine how much money it takes to run your cities and the states and the governments. The money for the police forces, the space program, military defense, national security, health research, all these programs, all these government programs, the taxpayers pay for them. There are different types of taxes. Property taxes are collected on the value of the property you own, like your home, automobile possibly. Sales taxes are collected when you buy items, you pay sales tax. Income taxes are taxes collected based on the amount of income that you earn. And the tax, that's simply the amount of money that you must pay the government. It's the price you pay to benefit from these government services that I was mentioning. They're collected by the IRS. You guys have heard that term before, the Internal Revenue Service. And it is tax season, so everybody must file their taxes by April 15th every year. When you file your taxes, your income taxes, there are different statuses that you can file under. Most of you guys will be filing single, unmarried taxpayers. There's also married filing jointly. So if you're married, you and your spouse can file together. There's married filing separately, which means you file separate returns. And then head of household, it's a special filing status for unmarried taxpayers who also support other people in their house. So as your income changes, your tax liability or your tax responsibility changes. So the Internal Revenue Service puts out what's called tax tables. Basically, it says if you earn X number of dollars, you owe this much in taxes, depending on how you file your taxes. So let's look at an example. Ron is single, so he's going to be filing as a single taxpayer. He's using the IRS tax form and calculates his taxable income to be $51,482. We're going to use the tax tables to find out how much he owes in taxes. So the tax tables, if you can see, this portion, this is only a small portion of the tax table but this is for people that have at least this much income, but less than this much income. So you can see it's broken down. So that first line would be at least $51,000, but less than $51,050. And you can write that as a compound inequality. You guys remember inequalities? So if your income, it's got to be greater than or equal to $51,000. That's this first line. That's what we're representing here. But it's less than $51,050. It can be symbolized in interval notation as this, where you put the variable in the middle, and then you put the $2 amounts on the outsides. Put the smaller one first, and then use a less than or equal to the income, which is less than the bigger amount. So if you'll set it up this way, it'll always be right. Put your variable in the middle. This is the income we're talking about. It's between $51,000 and $51,050. Just set it up just like this if you're asked to use interval notation. So Ron's taxable income is $51,482. So where he's at is in this area that's circled. See, it's at least $51,450, but less than $51,500. That's his income. So as a single taxpayer, we would find the column that says single taxpayer and come down to his dollar amount, which would be $92.13. So Ron would owe this much in taxes if that was his income and he was filing as a single taxpayer. So if R represents Ron's taxable income, express his tax interval as an inequality using interval notation. So R is the variable. Remember, we're going to set it up just like this. Use the smaller amount here and the larger amount here. And Ron is right here in this category from $51,450. Oops, that should not be, that should be like that. Up to $51,500. So his income is somewhere between $51,450, but less than $51,500. That's how we would do interval notation for Ron's income. Okay, some more tax tables. Maria and Don are married now. They're taxpayers filing a joint return. Their combined taxable income is $153,900. The IRS offers a tax schedule so that taxpayers can calculate their tax. This tax schedule for married filing jointly. So we want to use this schedule to figure out how much Maria and Don is going to owe in taxes. So if you read it, it says if your income is over this, but not over that, then you don't have to pay any taxes because you didn't make enough money to have any tax liability. If your income is between this and this, then you would pay this much in taxes plus 15% of the amount over this. If your income is here, $65,100 to $131,450, you would pay this much plus 25% of the amount over $65,100. Well, they're right here, $153,900. They're going to be in this category right here. So they're going to pay $25,500 based on this tax table, plus 28% of the amount over that. Okay, so they're paying $25,550 plus 28% of the amount over $131,450. So the amount over, they would be the amount over $131,450. So let's take their income, $153,900 minus $131,450 is equal to $22,450. So that's how much they're over. So they're going to pay 28% of this amount. So I'm going to multiply that times 0.28, and that's going to give me $6,286. So that's going to be added back to their flat tax rate of $25,550. So I'm going to add that back to $25,550 and get $31,836. So that's how we come up with that number. Using the table above, what taxable income would yield a tax of exactly $8,962.50. Using the table above, what taxable income would yield a tax of exactly $89,62.50? Well, if I look through this thing here, I'm seeing here's $89,62.50 plus 25% of the amount over that. Well, I want just exactly $89,62.50, which means it would be exactly the lowest amount here, which would be $65,100. So the answer to that would be $65,100. At $65,100, they're paying just that amount plus nothing more because they're not over that amount. Okay, here's another tax schedule. The IRS includes the tax schedule for information purposes only. For taxable income over $100,000, taxpayers must use the tax worksheet. Here's a portion of the worksheet for married taxpayers filing jointly. Calculate Maria and Don's tax using this worksheet. So Maria and Don's tax using this worksheet, well, their income was $153,900, which is going to fall into this. $153,900 times 28%. So let's do $153,900 times 0.28 would be 43092. And then this column D says subtract this amount from it. So minus 11,256 equals 31,836. So we come up with the same amount using this table as well. So we just took their same income based on this table. It says multiply by 28%. Multiply A times B, you get this. Subtract this amount. This is like a deduction. And this is their taxable amount. So what if Davida and John have a taxable income of $118,675? Use the married filing jointly worksheet above to determine the columns for A and C. What is their calculated tax? So $118,675 would fall right here. $118,675 would fall right there. Okay, so $118,675 times 25%, that's the multiplication amount on this table. The tables are different, but you're going to come up with the same dollar amount. So $118,675 times 0.25 is 2,966,875. 2,966,875. The deduction amount of 73,1250. I'm going to subtract that amount. So minus 7312.50 is equal to 22,356.25. So these tax tables, you just figure out the income amount, put it into the tax table, and see what, and then it's going to spit out the taxable, the tax based on the income.